Lately, the market have been pretty unpredictable and the sentiment is very bad. As you can see on the fear and greed index, we're at 13. We even went to 3, okay, a week ago. So in this video, we're going to discuss about what's happening now, if a recession will arrive, how to handle this market to avoid to lose money stupidly, and also why not to prepare to gain from all of this mess that is happening right now. If you go on YouTube, I'm sure you've seen this. You have Dalio, okay, US likely going to be in a recession. It's pretty much the same thing that he said in the interview that he has been saying for the last 5 years. You have as well a BlackRock CEO, Larry Fink, which says that the US is very close to a recession, okay, or eventually maybe in one. And you have Jamie Dimon saying pretty much the same thing, that for him, the inflation is still not gone, even if we have good numbers about it. The inflation is still a big problem that need to be addressed. Plus that, yeah, there is a slowdown, okay, and a recession is a likely outcome. If you type stock market on YouTube, you have only red, okay. Why the stock market is down after Trump tariffs pause, Trump blinks and bonds, China one plays the ball with the US, stock market drop, you have a stock market sell-off. This is what I'm doing. US market slump again as China trade war appear. Like, you really have mostly just bad things. The recession is back on the table. All the bad things are back on the table. Like, if you go to the Google News, it's pretty much the same. So here's what to do, what I do in this moment, okay? So let's start from the bottom this time. First one is don't wait for a crash, okay? A lot of people have been thinking that there will be another crash. Some say, no, we touched the bottom already. Now it can only get better with tariffs and so on. First thing, you need to understand the history. In the history, we already had a bad period where after this bad period of crash, we had a bottom and it did plus 10%, plus 14% in one day, and then crack again. This happened in the 80s, it happened in 2000, and it happened again in 2009, 2008, something like this. So it's not because we had a good rebound of 10% that it means that we were in a bottom. Plenty of time in the history. We had a big crash after it decreased by 30% more right after this. But, okay, don't wait for a crash. As Peter Lynch said, far more money has been lost by investors preparing for correction or trying to anticipate correction that has been lost in correction themselves. What is mean with this is you potentially losing a lot of money by not investing right now. You're potentially losing a lot of money because inflation is here. Inflation is a sure thing. You're losing 2, 3, 4, 5, 6% every year of your buying power if you're not invested. This is something that you cannot change. Don't expect to have a depression somehow, okay? Depression, if you take the last 200 years, last 100 years, it's happened like what? 5% of the time, 3% of the time, like you don't make any money from this. So don't keep your cash, okay? You may want to, if you have some cash available, yes, you can still have some good money with liquid assets and with a liquid account on Interactive Broker and so on, where you can get 4 or 5% on your USD. But yet, like, don't try to say, oh, I keep cash because I will invest when there will be a correction, then when there will be a crash. Most of people that try to do this, they actually never invest during the crash. They actually never invest during the crash. Like, seriously, look at all the people that say, I'm waiting to invest, I'm waiting the crash to invest. Look at their track record and look when they actually invested. Look at when they actually invested in their life. Did they invest in 2008, 2009? Did they invest during COVID-19, during the pandemic? Did they invest in 2022 during the market decline? Look at this. If they invested during those time, okay, why not? But most of them, they didn't invest. They didn't invest because when it's declining, they say, it will decline more. I'm waiting. It's stupid to buy now. And when it's going up again, they say now it's overvalued. I will wait that it come back to this level. So it's basically people that don't understand anything about economy, stock market, finance, and so on. Okay. So if you see a great company at a good price with good margin of safety, buy and hold. When I'm talking about margin of safety, put real margins of safety. Okay. I see many people that imagine that because a company have grew by 15% per year for the last decade, it will continue to grow like this for the next 5 to 10 years. Like this is wrong, okay? It's not like this that you estimate what will be the growth of a company. It's actually extremely difficult to estimate this. But let's say that if you have a track record for the company that for the last 20 years, it grew by 10% per year, and estimate all the analysts that are covering the company, all the experts in the field estimate that it should continue to grow by 10% per year. So, okay, you take some margin of safety and you imagine with all your model of valuation, you will say, I plan that it will grow by 7, by 8% per year. You take really big margins of safety. Why do you need to take margin of safety? Because even if the market has declined a little, we're still at a P ratio of 25 or something like this. If you take P ratio of S&P 500, okay, now the P is 25. 25 is still very high, okay? Like you want it to be around 20 to be maybe more aggressive, or even under 20 to be very aggressive. So this is the first thing. Second thing, it's the same with buybacks. It's not because the company this year or the next year is planning to do 10% buybacks that they will be able to do so. Because if a recession hit and they have less money, it's not sure that buyback will be their priority. So this is something important. With valuation, with the P ratio, it's not because the company had a P ratio of 35 on average for the last 10 years that it's supposed to stay around 35 for the next 10 years. It's something very important to understand. So be cautious with this. Always take some margins of safety with the P ratios that you will expect for the future. Okay, be extra careful because we have a lot of uncertainty, plus the market is high. We're paying a big premium on the market right now, on the American market at least, okay? So second thing, hold for long. Don't buy to hope to do a good deal, like don't buy something cheap to do a good deal and then sell again when you do 10, 20, 30%. Go for long run. If you don't feel comfortable holding for at least 10 years, don't invest. Really, if you don't feel comfortable with this, if you know that you will need your money soon, don't invest. If you know that this company, you don't see it really well for the next 10 years, it's not really clear where the company will be in the next 10 years, don't invest. If you don't feel comfortable to close your account, close your computer, close everything for 10 years and come back only after 10 years, don't invest. This is something very important. So know what to look for. Look for company with good numbers, okay? Quality company generally have outperformed normal company. So look for high return on invested capital, at least 15%. You can even go to 20% if the market like during this moment. Look for high operating margins, okay? Especially higher than the competition. Because you can have some company with 25% operating margin, but all the competition is at 25. No, you want your company to have higher operating margins than competitors because it means that if they need to fight, if there is a recession or something like this, they will be more prepared and they will have more a way to fight for this and to stay, to keep the leadership doing this. Look for companies that have grown the revenue, that have grown the EPS as well, and even better if they grow the EPS faster than the market, and look for companies that have a low debt level. Look for net debt to EBITDA under 3. Then look for company with a strong moat, and if possible with a moat that is growing. Look for companies that you really believe that their moat is becoming more and more powerful years after years. And the last thing, look for good value. We've talked about it. If you combine all of this, generally, you make good buy at a good price with a good value, with a strong moat, you should have an outperformance for the next year. I personally try to, with my DCF model, to have at least 13% per year with conservative PE, conservative growth, okay? I try to aim for companies that are 13% per year and sometimes even 15%. So try to take a lot of margin of safety, okay? And then the best way to have good value is to be contrarian and buy great companies when nobody wants them. Generally, when a company is cheap, it's because there is something happening. It's not cheap for nothing. So it's either something happening in the whole economy, okay, like we saw with tariffs when everything went down. So yes, you have company cheap just because everything went down, but you have also some company which are cheap because they are facing a problem right now, which will not affect the company for the next 10 years, but for the next 1 to 3 years, it may affect the company. This is how you get good deal. Don't expect to get a cheap company that nothing bad happen around the company or nothing which is perceived bad. It's very important to get it, like which is perceived bad, because on the fact, maybe nothing bad is happening, it's just the perception of the news actually and so on are bad. So this is what you need to find in company, because you will not have a cheap company for no reason. Like really, you don't have cheap company which are growing 20% per year, which are already undervalued and so on. If the company became cheap, it's maybe because before the company was extremely high valuation, so it had a correction for this. Maybe the whole industry is facing a problem. Maybe the whole economy is facing a problem. Maybe they have a trial or something like this going on, or they failed on some product, or they had a cybersecurity issue or something like this. So understand that there is always a reason why a company is cheap. So find this reason, understand it, and if you think this reason will not affect the business for the next 10 years, it will be only a short-term impact, then invest, because it's here that you will get the best deals.